When that guy comes into the market, for whatever reason, perhaps because of the lower unit costs that silver has relative to gold, they crowd into the silver space. And when they crowd into the silver space, traditionally, there hasn't been enough market cap in the silver silo to handle the money that comes in. And it doesn't go up, it explodes. By the way, you're not going to need RickRule to tell you when that happens. You're not anticipating a $35, $36, $37 move. The 3 times in my life, the gold price has escalated by 10 times or more. I'm not saying it's going to escalate. I'm not saying it's going to go to 300. But if I'm right about the gold price, which is to say that the gold price can go up 3 times from here, the silver price can do more than that. When it's going to happen, I don't know.
Gold edged higher during the early Asian session, supported by renewed geopolitical tensions in the Middle East. The reported U.S. airstrikes on Iranian nuclear facilities have injected a fresh wave of uncertainty into global markets, prompting investors to seek refuge in traditional safe haven assets. The conflict continues to dominate sentiment, with analysts warning of further volatility if the situation escalates. RickRule of Rule Investment Media points to gold's historical performance as a reminder of its long-term potential. "I've seen gold go up tenfold more than once," he says. "I'm not saying it'll happen again or that silver will hit $300, but if gold triples from here, and I think that's very possible, then silver could rise even more." Earlier in the year, many analysts expected silver demand to weaken under pressure from President Trump's renewed trade war and the rollback of renewable energy incentives. That outlook seemed validated in April when tariffs intensified, but silver prices have since rebounded sharply in June. This resurgence has triggered renewed interest among retail sellers, with coin shops and dealers reporting a spike in activity. Even in a more conservative scenario where gold only doubles over the next decade, Rule says the return would still be significant, particularly in the context of a weakening dollar. If the dollar weakens, gold tends to strengthen in nominal terms, which qualifies as a bull market, he adds. Daniel Hines, senior commodities strategist at ANZ, echoes this view, noting that gold has historically served as an effective hedge against geopolitical shocks. "This Middle East conflict threatens to be one of the biggest issues facing the world in recent memory," he says. "That is likely to trigger demand for gold as a haven, offsetting any concerns about the prospect of fewer U.S. rate cuts." Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Let's look at history, okay? The last time we had a period of rapidly declining U.S. dollar purchasing power was the 1970s. In the 1970s, the U.S. dollar lost 75% of its purchasing power, and gold ran 30-fold. 30-fold, okay? Now, I'm not suggesting the next 10 years that gold runs 30-fold, but I am suggesting in the next 10 years that gold loses 75% of its purchasing power again. And well, I don't know, and you've been interviewing me long enough to know I don't know. I suspect that the increase in the gold price will mirror the deterioration of the U.S. dollar, its purchasing power. That means that gold should rise 3-fold or 4-fold. Let's say I'm wrong and it doubles. That's not a horrific outcome. And armed with that knowledge, which is to say at least the nominal price of gold rises for 10 years, that meets the definition of a gold bull market. And gold bull markets follow predictable patterns. In the early stages of a bull market, what moves is gold, not the gold stocks. When you first started interviewing me, you expressed your viewers' frustrations that gold was moving, but the gold stocks weren't. And the explanation I gave to you is, first of all, this is the way history works. But secondly, one asset class, gold, had a buyer, foreign central banks. And foreign central banks don't buy gold stocks. So if one asset class has a buyer and the other asset class doesn't, of course the one that has a buyer goes up. And that's what happened. Like earlier bull markets, the momentum established by gold eventually spills into the gold stocks. It does that for 2 reasons. The move in the gold price validates the narrative to investors. They get interested in gold as a topic. But the second thing that happens is as the gold price increases faster than the input cost to produce it, the companies make more money. And we've seen that just in the last 15, 16 weeks. We've seen solid inflows into gold or ETFs, and the buying has been concentrated in the best of the best, the Wheaton Precious, guys like that. When that momentum establishes itself, courage and cash goes down the value chain. And that is what you saw in gold royalty, and that'll continue. I don't think of gold in isolation. I think it in juxtaposition to the U.S. dollar and the real U.S. dollar interest rate. The best way to answer that question, Daryl, is gold fully priced, is what set of circumstances would cause me to sell my gold? How would I identify it as overpriced? I own gold because I believe debt and deficits in the U.S. are out of control and will lead to the deterioration in purchasing power of the U.S. dollar. So what would cause me to sell my gold? Well, the first would be a balanced federal budget. We're $2 trillion out of budget and getting worse. The second would be a sane fiscal plan for dealing with $100 trillion in net present value of entitlements. We're a long way from there. The third would be declining real interest rates. And that's tougher to explain. A real interest rate is the plurality of the 10-year Treasury yield to the underlying rate of inflation. And this is the subtle part. Right now, if you believe the CPI, you believe inflation is 2.5%. The US 10-year Treasury rate is 4.5%. So you're getting a 200 basis point real yield. But if you believe, like I, that the underlying rate of inflation is 7.5%, you're getting paid 4.5%, it means that you have a minus 3% real yield. So for me to sell my gold, I would have to have a 200 basis point real yield to underlying inflation, which is to say that the US 10-year Treasury rate today would have to be 9.5%. If that's true, the first mortgage rate would be like 11%. If you look at all of that arithmetic, but particularly the real interest rate differential, you see that from my point of view, the reasons for me to own gold are very much intact. I'm not expecting gold to increase in price in real terms in the next 10 years, although it might. It might be because of the human psychology you talked about. It might be because it might be that the increase in the gold price causes people to overvalue the narrative and they buy too much. But all I'm counting on is that the gold price will mirror in nominal terms the deterioration of the purchasing power of the US dollar. It will maintain its purchasing power today in a currency that declines by 75%. I don't know if you remember this, but I remember one of the first interviews that you did. You were expressing your viewers' frustration that gold couldn't crack through $2,000 an ounce. I don't know if you remember this, but I think gold was 1,800 or something like that. And I said, you know what, Daryl, I don't own gold for a $200 or $300 move. I don't own it because I think it might go to 2. I own it because I think it might go to 9. And that's how I feel about silver. To me, the difference between 36 and 34, mixed knocks. I came into the silver market in 1970 when it was $1.20 an ounce. At the end of the decade, it was $50 an ounce. When you see a silver bull market, silver is much more volatile than gold. I don't know why it is, but here's what I know about silver. A precious metals bull market is led by gold, and the price momentum is established by gold. And when the price momentum validates the narrative around precious metals for the generalist investor, not the precious metals investor, but the generalist investor, the Fidelity guy, the Vanguard guy, pardon me, when that guy comes into the market, for whatever reason, perhaps because of the lower unit costs that silver has relative to gold, they crowd into the silver space. And when they crowd into the silver space, traditionally, there hasn't been enough market cap in the silver silo to handle the money that comes in. And it doesn't go up, it explodes. By the way, you're not going to need RickRule to tell you when that happens. You're not anticipating a $35, $36, $37 move. The 3 times in my life, the gold price has escalated by 10 times or more. I'm not saying it's going to escalate. I'm not saying it's going to go to 300. But if I'm right about the gold price, which is to say that the gold price could go up 3 times from here, the silver price can do more than that. When it's going to happen, I don't know. One of the things I've noticed, Daryl, as you know, I've graded tens of thousands of portfolios. Anybody who wants can go to ruleinvestmentmedia.com, list your resource stock portfolio, I'll grade it. And one of the things I've really, truly learned is that while a lot of people get the strategy right, they say the price of gold has to go up and the price of silver has to go up more. And that could be a 3-year or 4-year or 5-year phenomenon. So they get the strategy right, but they get the tactics wrong. They're afraid to hold the asset class over a long weekend when they're taking on a 3 to 5 year strategy. Or they think that what they want matters. Okay, I got my silver position. Now it needs to go up by Thanksgiving. You think the silver market cares what you want? So people got to wrap their heads around this. I absolutely positively believe that in a nominal sense, the silver price at least triples. At least. When's that going to happen? I don't know. I have no way to know. So I don't seek to know. I just know that when it moves, it really, really, really moves. I can psychologically and financially afford the risk to wait, and the volatility doesn't bother me at all. If it goes to 36, I'm not excited. If it falls to 33, I'm not depressed. Like we said at the beginning of the discussion, that's the difference between music and noise. Those little moves are just noise. $100 silver? No, that's more like music.
U.S. inflation likely crept higher in May, offering little sign of immediate tariff-driven pressure, though the Federal Reserve expects such effects to become more evident later this year. With fresh CPI data due Friday and following the Fed's decision to hold rates steady, Chair Jerome Powell is set to testify before Congress. He's expected to reiterate the central bank's cautious stance, acknowledging the potential for rate cuts while emphasizing the need for more clarity around the economic impact of the current trade policy. RickRule, a longtime critic of official inflation metrics, argues that the actual cost of living has risen far more dramatically than the reported figures suggest. Gas prices have tripled, mortgage and insurance rates have doubled, groceries are up 60 to 70%, and taxes have soared across the board. Yet officials claim inflation is just 2.5%? That's not CPI. It's a CP lie, he says. During the pandemic, CPI inflation peaked at 9% in June 2022. Economists explain this spike using a framework that attributes inflation to long-term expectations, labor market tightness, and sector-specific price shifts, such as those in the energy and automotive industries. While inflation has since eased, core inflation in 2025 remains above the Fed's target, suggesting further softening of the labor market may be needed to bring it fully under control. Let's get back to the interview.
There's a wonderful quote. I think it was Gore Vidal, hardly a conservative, by the way, who said that you can understand the process of politics if you understand the root of the word. Poly is from the Greek for many, and tick is from the English colloquial for small blood-sucking insect. If you think of Congress and the voters, frankly, as being a bunch of small blood-sucking insects, you understand the process. Going back to 1980, Ronald Reagan was elected president with a huge plurality, not a small plurality like Trump enjoyed, but a huge plurality. And his whole campaign was cut the size of government, reduce government, get the yoke of government off your back. And that resonated with Americans. Rich, poor, yellow, black, brown, white, resonated with Americans. Despite that, the political interests of Americans represented in Congress, Democratic and Republican, derailed the Reagan Revolution within 6 months of Reagan's inauguration. The people in Congress are elected by us to maximize our benefits at the expense of other parts of society and minimize the call that other parts of society have on us. That means that they have an intrinsic interest in increasing expenditure. And the class that gets penalized the most is the unborn. And that doesn't change. Department of Government Efficiency was always theater. How has it worked out? Well, let's look at the first Trump budget. First of all, we scrapped the debt ceiling. If you're going to reduce debt, why would you scrap the debt ceiling? They proposed the fourth largest deficit in history, but even that was smoke and mirrors because the savings come 4 years from now, while the expenditure comes today. Department of Government Efficiency allegedly identified $160 billion worth of fraud. Daryl, have you seen any indictments? Fraud is an indictable offense. If there was $160 billion in fraud, where are the indictments? If there was $200 billion in savings, why are the deficits where they are? This was and is theater, pure theater. Now, it's interesting that on the Democratic side of the aisle, that they are attacking several items of the Trump budget in terms of expenditure. Does this mean that the Democrats are anti-expenditure? Of course not. It means they want to spend it on their shit, not his shit. And what does all this mean for you and me? What it means, for reasons that we can discuss later in this interview, that is to the extent that you're counting on the rest of the world to look after you, you got to change your thinking. You got to look after you. The decade that we have coming in front of us is going to be a lot different than the 4 decades that preceded this one. And the way that you prepare for it, the way that you deal for it, the way that you save for it, the way that you invest for it is going to have to change. That's very, very important. Things are changing, and you can't rely on other people to fix that for you. You got to fix it for you. I think that your motto is save, invest, prosper, something like that. That's what it's about for the next 10 years. It's not coast, relax, spend. That's not what it's about. Let's talk about inflation, first of all. Most folks that don't wreck their life the way I wrecked mine studying all this stuff, folks that have lives, they think that inflation is measured by the CPI, if they think about inflation at all. If you believe in the CPI, it suggests that inflation is 2.5%. Now, my definition of inflation is the deterioration of the purchasing power of the US dollar. That is, the fact that my savings and my salary buys less and less and less every year. Simple common sense, knowing your household budget. Period 2020 to 2025, gasoline prices have almost tripled. I don't know what your property tax bill is, or your sales tax bill, or your income tax bill, or your capital gains tax bill, or your fuel taxes, or your excise taxes. But the idea that your tax take has only increased by 2.5% a year since the year 2020 is stupid. Home mortgage rates have doubled. Health insurance rates have doubled. Grocery prices are up 60 or 70%. And these morons tell you that the deterioration of your purchasing power is 2.5% a year. So it's important that your listeners understand that the CPI is a CP lie. And that has profound implications. Not you, Daryl, but one of your older relatives, somebody who's more my age, and they're making, they're 70 years of age, and they're expecting to live to 85 or 90 or something like that. And they believe that given their savings, that they're okay with their Social Security. They're planning on Social Security. The problem is that while they likely continue to get Social Security, inflation means that their Social Security check will buy them less and less and less. Now, there's nothing you can do about it, so there's no sense fretting. But what you can do is save more, postpone retirement, invest better. This coast thing in the period 1982 to 2022, these were the most benign periods in economic history. Real interest rates fell, nominal interest rates fell. The stock market went crazy because of the baby boomer demographics. That was great, especially great for folks like me who really benefited from it. But all that's changed. So to the extent that your expectation of the future is predicated by your experience in the past, you're going to have a hard time for the next 10 years. Very, very, very hard time. And you can't just curl up in the corner in fetal position and say, I quit. Let's do the arithmetic around it. Let's start with the premise, and I'll defend this later. Let's start with the premise that very much like the decade of the 1970s, in the next 10 years, the purchasing power of the US dollar will decline by 75%. That has two implications. You're not an old codger like me yet, but if you are an old codger like me, I don't know what Social Security pays me, $4,000 a month, $4,500 a month, something like that. They're not going to change that. They're going to keep paying me, but it's going to buy less. My $4,000 today will buy me $1,000 worth of goods and services 10 years from now. So when you look at your retirement benefit, if you're going to get $4,000 or $5,000 a month, understand that that'll buy you $1,000 or $1,200 worth of stuff in today's dollars. So you're likely going to have to augment it or supplement it. On the other side of the equation, you are going to have to look at investments that do well during periods of time when inflation goes up and interest rates go up. If you'd bought a triplex in 1970, what happened was that your rents rose, but your mortgage went from 5% to 16% over 10 years. And if you had to refinance, if you didn't have fixed rate mortgages, even though your rents rose, you may have lost that triplex in the decade of the 70s. So you need to make sure, as an example, with income producing real estate, that either your financing is fixed, so it can't rise, or else your real estate is unique enough that you can raise rents fast enough to compensate for rising interest rates. And you need to look at asset classes that benefit from inflation, gold, of course, being one of those. It's important to note, Daryl, that's not the only way up the cliff.
Across history, moments of crisis have consistently realigned investor priorities, and today's environment appears no different. Rising tensions, unpredictable monetary signals, and public skepticism around official inflation data are once again spotlighting gold and silver as more than mere commodities. They've become tools of protection and storehouses of trust in an increasingly unstable system. As traditional economic indicators face growing criticism, the metals market may serve as a more accurate indicator of financial unease and shifting confidence. Are precious metals becoming the new litmus test for public trust in economic leadership? And if so, how far might this trend go as the global picture becomes more fractured? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.